Today we're going to get into a topic that you probably hear a lot on our channel. It's specifically about whole life, and is this right for you? Rob, so the question that's being asked today is, you know, it's all about whole life, right? So, you know, explain to the audience here, what is whole life insurance?
Okay. Once again, whole life in general terms is permanent insurance. If you fund it for the time that you're supposed to fund it based on the contract that you have a death benefit that never expires. It's guaranteed. Each year, the cost of insurance significantly reduces, right? Your cash value grows as if your death benefit grows if you use the dividend to buy more insurance. And the point of whole life is it has a savings component that can really be a good complement to your overall asset base and structure. And if you're an entrepreneur that really wants to be able to take control over your own destiny financially through leverage, liquidity, and control, whole life in that scenario can become like a Swiss Army knife of financial planning.
Right. So when we think about whole life, are there a few different people, or like who gets whole life insurance? Is it only the entrepreneur, or is this for everybody?
You know, that's a dynamite question. And in the industry, let me just tackle this two ways. And once again, myself and Eddie, we're not fiduciaries. A lot of times you'll hear opinions from a lot of different people based on a lot of different situations. And sometimes these opinions are at cocktail parties and they sound really good. But the truth is, unless you're going to monitor and measure, the truth is if your financial planner, AKA your fiduciary, is on the same page as your insurance agent, who's on the same page as your accountant, as well as your estate attorney, I assure you that's good for you, and whole life insurance becomes a powerful tool. Sometimes you'll get some educated fiduciaries that, because they have become a fiduciary, let's say in the last 15 years, and Eddie, you know this, if you look at the market the last 15 years, it's done nothing except go up.
Yeah.
Right?
Yeah.
Look at all the indices. So anyone that fits that 15, 20-year block that's only seen the stock market go higher since there was, you know, money being printed in 2008 and 2009, they're going to tell you not to buy whole life. Just like a traditional accountant who is going to encourage you to get it. And I'm speaking in general terms right here, but they're going to say, listen, why buy whole life? Just buy a 401k or an IRA so you can get the write-off, but they're not telling you that the money's in jail till 59 and a half in the form of, you know, getting access to it. And then it goes on probation when you start taking that money out because it gets taxed at ordinary income. Nobody wants to tell you that. They just want to tell you that whole life is expensive, right? Yeah. Now, if you do proper planning, right, and if you understand the advantages and disadvantages of all the financial products that are out there today, and by the way, folks, if you really understand what your financial game plan is, whole life with a long-term point of view becomes one of the most powerful, if not the most powerful tool that you have in that toolbox. That's my opinion, because it allows you to do things and be able to act on things when economic winter or sector economic winter comes your way.
Yeah, you know, you bring up a...
Take that and rewind it back. You might want to press rewind and take some notes.
You bring up a really good
and
point.
Don't player hate. Listen, I'm just keeping it real, right? I'm keeping it real. For all you fiduciaries, CFPs out there, you do a checkup from the neck up and go back 20 and 30 years, and then you can have a different conversation. Sorry.
No, it's a great point, because the idea of the market going straight up, right, since probably 08, 09.
But that's not even true, because it goes like this. It doesn't go straight up.
Of course.
Yeah.
But a lot of people in their working career have never experienced an 08 or 09.
Yeah.
Or a 2000, 2001, 99, right? Like they haven't seen those things.
True. That means you and I are getting older, by the way. So I know Parker has no idea what 08 looks like. Go ahead.
So people will tell me like, oh, you know, the pandemic, that was a bad market. I'm like, well, you know, that was a bad month, right?
Yes. Yes.
The fact that the Dow dropped to 18, right, and then just shot straight back up while we had the lowest unemployment, while businesses were going out of business, while people were struggling financially, and you think about, well, does that really make sense? Talk about a little bit about whole life insurance companies,
Yeah.
right? How long have they been around?
Yeah.
You know, in general, what do they look like? What kind of markets
Yeah.
have life insurance companies seen?
That's a great question. And I'm going to ask you real fast to clarify one thing, but I know back in '08 when the government had to bail out, I forget which insurance carrier was that, and it was a P&C company. It wasn't a whole life company.
So I know one of the carriers that was getting bailed out was AIG.
Yes. So let me that's a great distinction, because a lot of times I'll get asked by folks who were around in 2008, hey, do these mutual life insurance companies go out of business? And they were confusing that with AIG.
Yeah.
So there is a difference, right? AIG was more of a P&C company.
Yep.
And the government had to bail them out because Bear Stearns just went out of business.
Right.
And there was a trickle effect that was happening. When it comes to the whole life carriers, the ones that we look at typically have zero debt. They don't issue bonds at all. They have a surplus in the trillions, if not the billions.
Yep.
Right?
Yep.
Which one is it?
Billions.
It's in the billions. They have a surplus in the billions. Always double check everything we say. And they are experts at how they invest money, right? And their investment produces dividends for all the policyholders in these mutual life insurance companies. Part of the dividends is based on interest rates in our society, which, as we know, are at least 50-year lows right now.
Right.
And these carriers are still producing dividends. Now, each carrier at the highest level is a little bit different on how they do their measurements.
Yes.
But for the most part, when you look at the carriers and your money's being invested there, they're the ones that are managing the money when you make those payments to your whole life policies. They have a 150-year track record of doing some excellent things. In other words, some of the carriers that we currently work with haven't missed a dividend payment since 1850.
Right.
Go check it out. That includes the Spanish-American War, the Civil War, World War I, the Roaring '20s, the Depression of the '30s, haven't missed a dividend payment. I'm not going to name the carrier, though you go do your research. You have also World War II, Korean War, the stock market crash of 1973. That's when ERISA was created, by the way, and that's when the government formed a partnership with, let's call it, the financial institutions, where they created the 401ks and began to replace the pensions, right? We know that 1980, when interest rates skyrocketed, these dividends and these carriers went up higher because they kind of track what the interest rates in our societies look like.
Yeah.
They still paid a dividend in 1987, stock market crash. 1990, Chubb Rock jumped on the scene, mean, lean, and a pocket full of green. But at the same time, that was the first ground war in Iraq. They paid dividends. 1997, I always remember this because we had the Asian contagion. The Dow went from 12,000 to 7,000. Check it out. Don't take my word for it. They paid a dividend. And then we had what was the most interesting thing for me, because this is when my career really started. Internet stocks in the late 90s, as you may recall, were running no different than some of these Bitcoins, right?
Yes.
And all of a sudden, out of nowhere, there was no calamity bell that went. No one got a warning.
Right.
But just one day, the internet stopped, the stocks, and they began to go back down again. That was right around the time the government sued Microsoft, which began the rebirth and the next run of Apple as Microsoft took a step back.
Yeah.
Makes you think there's a conspiracy here, no? And then the second ground war, which happened after 9/11, they still paid a dividend. But most importantly, when the credit crisis hit us at 07 and 08, they paid a dividend.
Yeah.
Right? So to Eddie's point, the question is, how financially stable are these carriers at the highest level? Under every economic situation over the last 150 years, they've proven to be a formidable ally in your world when it comes to your money.
Yeah. You know, you brought up something that little off topic of whole life, but this idea of the government creating ERISA. And, you know, people think about the 401k as this great benefit that the government's giving you because you're saving on taxes. But as you know, you're not saving anything. You're deferring it into a future date.
Yep.
And from a conspiratorial standpoint, like, why would they do that? Why would they want to defer taxes out into the future? I think about a couple things. One, when they started to get rid of pensions, well, we know that for our business owner employees, a pension can be a significant tax write-off, right? They can really reduce their tax liability today. So if they're moving to 401ks, maybe that was one of the reasons they wanted to get rid of that break that the companies were getting and maybe collect more revenue that way.
Yeah.
But, you know, when we're looking at whole life insurance and we're talking about deferring taxes, paying taxes, all those things, can you speak a little bit about the taxability or what happens with whole life insurance?
Yeah, I'd like to, if I could address this a couple ways.
Yeah.
I want to just go back to one thing because, you know, myself and Ed have the good fortune of working with a lot of different clients, and we are never here to or not to say do a 401k.
Correct.
Right? What I admire about a 401k from a standpoint of commitment and consistency is that folks that do it over 10, 20, 30 years, they're consistently saving money.
And if they're saving money, that's better than not doing anything at all.
Better than not saving, so they've created that discipline,
Yes.
right? So it's no different than if somebody's eating right or if they're working out right. You know, now within eating and within working out, you could really massively accelerate if you really kind of get into the micro distinctions. But
Right.
the person that's saving into a 401k is going to do better than a person that's not.
Correct.
That's a fair statement,
Yes.
right? Now, when we look at whole life insurance, both in business planning and individual, I'll go individual first. The individual person out there, think of a Roth IRA. A whole life policy has those characteristics where it grows, comes back tax-free. Now, to maintain the tax-free status inside a whole life policy, you would go up to basis. So if you put out $1 million over 30 years and the cash value is worth $2 million, that first $1 million is money that you put in, so that's all tax-free. To maintain that tax-free status, once you break $1 million, you would then borrow from the policy. And if anyone knows anything about borrowing money, it's not taxable, right?
Right.
So these policies give you that gift and that ability later on in life if it's structured the right way.
Yeah.
Right? And I mean if it's structured the right way.
Correct.
Now, you could also use for the doctor group that's out there or the entrepreneur, and your business is exploding and you got a lot of revenues and you want to create your own private pension plan and get a write-off.
Yeah.
Remember, you're going to get taxed on the way out, but now you could fund these pension plans with whole life insurance, which will give you that defined guaranteed monthly benefit later on in life.
Yeah.
So those are two different tools that you can do with whole life insurance.
The one distinction I like to talk about is the death benefit, because I think a lot of times people don't understand. They think they're getting taxed on that death benefit.
No.
Yeah. It
goes in. So once again, a state attorney, accountant, right?
Yeah.
You want to properly structure out what your world looks like. But remember, if you're married, I believe each spouse gets a $5.5 million credit.
It's 11 right now, and for each $22 million.
Oh, it is 11.
Yeah.
Okay. All right. So it's 11 each, and there's a sunset provision.
Yes.
The point is, it does get added to the taxable estate, the death benefit,
Yes.
right? But if it's set up properly in trust and everything else, you could keep that out of the estate.
And even for simple terms, right? If your husband passes away with $1 million death benefit, leaves it to their spouse.
So, yep. She gets a $1 million check tax free.
$1 million check. Whereas if there's a 401k with $1 million left,
They got a 10-year stretch or a 5-year stretch,
Even
and it gets
if-
taxed at ordinary income.
taxed at ordinary income.
Yep.
And I think that's the big distinction, because you brought it up before, but I think people, while 401ks are great as a savings tool, so many people that we talk to that get to 60, 65 and really have no idea that $1 million isn't worth $1 million in their 401k.
Yeah, there's, and once again, and I always want to clarify this
Yeah.
in case you're just listening now, we're not fiduciaries. We are not bad-mouthing the 401k. What we are doing, though, is we're providing education right now. So every decision you make, understand the benefits and the challenges.
Right.
And the benefit is a write-off and a match.
Yes.
The challenge is that if you get a write-off today, right, you're going to have to pay that back later on. And later on, we don't know what the tax bracket's going to be.
Exactly.
So there's some uncertainty. Plus, we don't know what the market's going to do for the next 5, 10, 15, 20 years. And remember, when you're in that retirement red zone, let's say age 55 to 65.
Yes.
And if we go back to 08, when the market was down 37%, but intra-year down 53%.
Yes.
If you were 60 and your 401k was worth $2 million, that year you lost a lot of money.
Yes.
And you were close to taking distribution. So proper planning would say diversify within and amongst asset classes so you could put yourself in a position to be able to protect and at the same time take advantage of opportunities that you
Right.
can't see coming.
So we've touched on a lot of different pieces here. Let's talk about some of the pitfalls or some of the traps that people should watch out for in whole life insurance?
Good. Thank you for that. One of the biggest challenges for whole life, and I'll tell you this right now, if you do it for 1 or 2 years, don't do it. It's not worth it. Because you're not really understanding the true value of it. The true value, like anything else you do, if you're gonna buy real estate, you don't just buy one property and stop. If you want to be able to maximize your overall real estate strategies, or if you want a dollar cost average in the stock market, you don't just do it for 2 months and stop. So whole life, if you did it for 1 or 2 years and just completely stopped, it's not worth it. Just like anything else, if you did it for 1 or 2 years, it's not worth it.
Right. Yeah.
That's the best. I mean, someone could say to you, hey, if you put that same money in the stock market, all right, ready?
Yep.
So let's say if you did a whole life policy for 10 years, right? And then all of a sudden someone comes up and says, yeah, but if you would have took that same money and got 7% in the market over the last 10 years, it would be worth more. And my response to that would be, well, is it in an IRA? If it wasn't in an IRA, what was the taxes? What did the market do intra-year? Sequence of returns, rate, risk. And oh, by the way, what are the fees? And I think once you look at all that and you kind of put it all apples to apples, those are very similar. The difference is inside the whole life, you not only have a death benefit, which is for your future value, but there's also goodies in there that protect you from disability, lawsuit, inflation, and interest rates. You got to check the fine print, check the state. But at the end of the day, it's important to understand all the different overall mixes that are in there. And by the way, we are not saying buy whole life and don't do the 401k,
right,
or don't do the stock market, or don't do real estate. We're just simply saying if you put that in the mix, good things are going to happen.
Absolutely. And I think one of the pitfalls that I generally see when working with people is they say, hey, I have this whole life insurance policy. And when we actually look at it, it's not whole life.
Oh, yeah.
So, I think buyer beware, right? Make sure that you're working with the proper team to go through and analyze this. One of the other things you touched on briefly was the idea of mutuality, mutual company versus stock company.
Yep.
And I think that's another thing to look out for, because stock companies, they're beholden to Wall Street, right? They're shareholders.
Yeah.
Whereas a mutual company, the reason they're around for 150 plus years, a lot of these companies, is because they're making decisions for the long term. They're not looking at next quarter and trying to do the next best thing.
Yes.
Right? So
well said.
I think really understanding the products that you're getting into is, if you do that, good things will happen.
And let me just add this, because this was I would say a very high level conversation on whole life. We touched on pensions and pre-tax, post-tax, and so you may have some questions and you may have some comments. Please throw some comments or questions below. But more importantly, that's the money train. No obligation on your part. If you have any specific questions and you want to speak to one of the members here at Epic, go ahead and click that link below. Somebody will get on the phone with you and take you through that conversation, answer any questions you may have. And once again, every single day, we are dropping content. We are bringing information for the purposes of providing financial education for you. Keep in mind, I grew up in a very scarce financial environment growing up, and we want to be able to share with you how, from a mindset perspective, to be able to go from scarce to abundant. And at the end of the day, I don't want anyone to have to feel the way I felt growing up when it came to money.